Hi everyone, welcome to my segment at the Canadian Investors Conference. Thanks for joining. My name is Robin Speziale, and I'm the national best-selling author of a book called Market Masters: Interviews with Canada's Top Investors. Here's the book. This was a proud moment for me back in February 2016. It was when I first unboxed my copies of Market Masters. The book was released worldwide in Chapters, Kohl's, Indigo, as well as online on Amazon.ca, .com, Barnes & Noble. 2 months after its release, it became a national bestseller. What I'll be talking about today, the focus of the presentation, is what I learned from Canada's top investors. I met with 28 top investors in Canada to write Market Masters, and I'll be sharing with you their investing strategies that you can apply to your own investing. Here's what I'll talk about. First, I'll get into my personal finance journey. Then I'll go over the market and its dynamics. And then I'll go into the investing strategies of top investors. Disclaimer, I am not a financial advisor. This presentation does not contain any stock recommendations. Investing always has inherent risk, and please consult a professional. So here's my personal finance journey. In high school, I worked a couple of odd jobs delivering papers. I was a mechanic. I painted houses in the summertime. I also worked at Best Buy. By the time I left high school, I had generated about $10,000 and invested those in bonds. Then I started out at the University of Waterloo. In my dorm room in my first year, I opened up a brokerage account, and I turned that $10,000 combined with the earnings from co-op into $50,000. I graduated from UW in 2010 and continued to earn money through work, and I turned that money into more money through investing in stocks. So to $100,000, $250,000, and today my equity portfolio is around $300,000. I'm on the path to financial independence, knock on wood. How I did it, pretty simple, like in hindsight, and this is really all I do. Earn money, save it, invest it, repeat. Earn money, save it. Remember, it's not what you make, really, it's what you keep. Invest it and repeat. So compound returns, that was huge for me. When I was in high school, I learned that capital appreciation plus dividend return, your total compound return, that's money that works for you. So you invest in the stock that earns 10%, goes up 10%, and then a 5% yield, that's a 15% total return. So it was an epiphany for me, like Homer Simpson here. Essentially in year one, if you take $100 and you return 10%, you generate $110 worth. And then year two, that $110, let's say it grows again at 10%, then you're up to $121, and you compound again and again and again. Then you can do this for years. 10% is just an example. Now from 1934 until now, the Toronto Stock Exchange, or the market here, has generated on average 9.8%. So if you had invested in $1,000, it would grow to about 1.6 million. So bull and bear markets, let's dig into the market a little bit more. So this shows the TSX Composite Index here from 1956 to 2016. And this chart's great. It's sourced from Mackenzie Investments. They update this every year or so. Then it shows all the bull markets and all the bear markets, again, since 1956 in the TSX. And what this hits home for me is that bull markets go up higher and they last longer than bear markets. So the average bull market goes up 124%, lasts for 50 months. The average bear market goes down 28% and only lasts 9 months. So for example, in 2015, when the TSX has dropped about 25% since 2014, I applied money into the market knowing that the average drop of a bear market is 28%. And you can use this knowledge to your advantage. If you take a look at this, if you track the market, it really is a system, and it goes through cycles. Okay, who knows how long this upcycle will last, but again, we did get out of that bear market in 2015, and 2016 was a good year for the TSX. We actually beat the Dow Jones Industrial Average and the S&P 500 in the year 2016, and my portfolio was up on average around 22% last year. So again, I recommend you to download this chart, print it out. Bull and Bear Markets by Mackenzie Investments. So let's talk about this again. So time in the market. Okay, over the past 80 years, an investment in Canadian stocks has grown 1,600-fold, despite 13 recessions, double-digit interest rates, and several world crises. Again, Canadian stocks have returned an average of 9.8% compound returns since 1934, and as we saw in that chart, following each downturn, which is a bear market, stocks have gone on to reach new highs. So if you're interested in trying to evaluate the market and whether we're overvalued or undervalued, I recommend taking a look at the CAPE ratio, the cyclically adjusted PE ratio, which was developed by Robert Shiller. And instead of just taking the price of the S&P 500 and dividing it by its earnings, what Robert Shiller did, he took the S&P 500 and divided by the past 10 years, so the average earnings over the past 10 years. And to him, he was able to get a better, clearer picture of market valuations. And so the average CAPE ratio is just right around 25. And so this chart shows that, for example, Black Tuesday in 1929, the CAPE ratio was above 25, as well as the dot-com bust. And then thirdly, the 2007 financial crisis. Shiller expressed concern that, again, a CAPE of over 25 was a level that has been surpassed since 1881 in only those three occasions, 1929, 1999, and 2007. Every time the CAPE ratio surpassed 25, went above 25, major market drops followed those peaks. As you can see, into 2015, 16, the CAPE ratio started to go above 25. Okay, so Market Masters. I interviewed 28 top investors in Canada for my book. There are many different investing strategies. I bucket each of those 28 investors into an investing strategy. And there's 600 pages in total, but you can read them in short bursts. So here's just a look at some of the top investors that I met. Just to name a couple, and there's Barry Schwartz, Benj Gallander, Bill Ackman, Francis Chou, Derek Foster, Jason Donville, Martin Braun, Norman Levine. Now there's Peter Brigger here, Peter Hodgson, Randy Cass, Som Safe. Some of these you may know, some not. And again, there's all the investors are bucketed into investing styles. There's value investors, there's growth investors, fundamental investors, macro investors, which go top down to the bottom up, and there's other. So let's explore some of the investing strategies covered in my book, Market Masters. We're gonna take a look at 7 top investors of the 28 and their investing strategies. Okay, first up, Francis Chou. Francis Chou came to Canada when he was pretty young, in his 20s, and his first job was as a repairman for Bell Canada. What he did, though, is that after finding his passion in investing, and value investing specifically, after reading The Intelligent Investor by Benjamin Graham, Francis Chou gathered a couple of his fellow repairman colleagues at Bell, and they pitched in whatever money they had into this investment club, and Francis Chou started to invest that money. That investment club blossomed into Chou Associates, which is a fund that he's running today. He manages in excess of $1 billion. Francis Chou is a value investor, And what value investors do is that they buy stocks that trade below their intrinsic value. So what does that mean? So there's a market capitalization of a company, which are the shares outstanding times the share price. And that's the value that the market is giving that company. Then there's the book value or equity value. And you can find that in the financial statements of that company on the balance sheet. And it's calculated by taking the assets minus the liabilities. That will give you your book value or equity. And what Francis likes to do, he likes to buy stocks that, again, their book value is trading above its market capitalization. To him, he's buying that stock at a discount. Now it's kind of going to a grocery store when you see the price of milk marked down from $1.50, let's say, to $1. It's still the same carton of milk, you're just getting it for a better deal. So next up is Jason Donville. He's on the other side of the spectrum here. He's a growth investor. And what he does is that he doesn't buy, let's say, beaten up companies, ones that are experiencing short-term negative sentiment. He likes good companies run by very able managers, have a stellar track record, great product, great service. But what he does is that the foundation of his investing strategy is return on equity. So he, on a quarterly basis and even more frequent, he scans for stocks on the exchange that have an ROE, or return on equity, of 20% or higher. So for example, Constellation Software is a Canadian company, technology company, that has an excess of 20% return on equity over 7 years and more. And Jason Donville invested in that company years ago, and Constellation Software has turned into a 10-bagger for him. So his investment, let's say of $1,000, effectively turned into $10,000, a 10-bagger, 10 times. And you can do this too. You can go to Google Finance. You can go to the stock screener on Google Finance. You can choose the Toronto Stock Exchange or the New York Stock Exchange, and you can filter companies that have a ROE, return on equity, of 20% or higher. Take a closer look at those companies. Make sure they have sustainable competitive advantage, good product, good service, and again, consistent free cash flow, consistent earnings, and consistent and growing book value per share. These are all things that Jason Donville focuses on when he invests in his companies. Okay, now I'll go to Derek Foster. So Derek Foster does not invest other people's money. He started young, and he was working full time, invested his money. In his 30s, he built his stock portfolio to right around $1 million. And what Derek Foster does, I call him a fundamental investor. He's neither value nor growth, but he buys high quality companies with extremely durable competitive advantages. One such company that Derek Foster invests in is Colgate. Okay, so most likely you buy and you use Colgate toothpaste twice a day at least. These are companies that Derek likes to buy. He calls himself the idiot millionaire because he makes investing very simple. Derek has a lot of great books that you can find in Indigo, Chapters, and Coles. So it's not just my interview with him that you'll learn about Derek. But what I will say, obviously, is that he's not a complete idiot. He coins himself the idiot millionaire because he made a very big leveraged bet on Philip Morris when he was younger, and he more than doubled his money on that bet. And again, it was easier for him to build that $1 million portfolio in his 30s, and then put that money, reallocate that money into more sustainable blue chip companies like Colgate that generate dividends for him now. One can, let's say, create a portfolio that has a dividend yield of about 4 to 5%, let's say. Then there's David Burrows. So David Burrows is a top-down investor. The first three are bottom-up. So top-down, or what you can call a macro investor. And so what David Burrows looks at is that he looks at countries, he looks at industries, and he looks at the capital inflows into those areas. He doesn't look at the companies per se. But let's say back in 2015, when the bear market in commodities started really in 2011, and 2015 into 2016, you could really see a shift of capital starting to go back into those industries, especially mining. And so David Burrows would be one to keep a keen eye on money going back into an area, and he calls that breadth expansion. So when you see increased volume, again, increased capital flows into countries, into industries, he'll buy a basket of the companies, let's say mining companies, and he'll hold on to the basket as long as he keeps seeing those capital inflows. So the next investor we'll get into, which is, actually we'll take a little break here. We got to wait until the next slide goes. Okay, now we'll talk about Ross Grant. So Ross Grant, he was passed the torch, and that torch is Beat the TSX, which for years was run by David Stanley in the Canadian Money Saver magazine. It's a great magazine, which is now run by Peter Hodgson. But Ross Grant, in running the Beat the TSX model, what he does is that every year, so the start of the year, let's say January 2nd, he'll take a look at the TSX 60 list of stocks, and he'll sort that list of TSX 60 stocks by dividend yield. So from the highest dividend yield to the lowest. And what he does is that he first strips out any of the former income trusts, okay, from that list. He takes out any energy names as well, and the top 10 highest dividend yielding companies on that TSX 60 list are then stocks in which he invests in. Now, by doing that every year, it's had a track record of about 26 years now. The Beat the TSX model has generated a return close to 13%. So that includes, again, the stock prices going up, the capital appreciation, along with those high dividend yields. And the beauty of the TSX 60 list is that these are some of the biggest publicly traded companies in Canada, strong durable advantages like Bell, Rogers, just to name a few. So next up is Bill Ackman. Now, Bill isn't Canadian, but I contacted him and I said, Bill, you invested in a lot of Canadian companies over the past couple of years, and I want you in Market Masters. Bill agreed, which is great. Some of those Canadian companies, he invested into Wendy's, just to spin off Tim Hortons. He also invested in Canadian Pacific Railway and installed Hunter Harrison as the CEO to run it and improve its operations considerably. And then most recently investing in Valiant, which as many of you know didn't turn out as well as he had hoped, but he has stuck with that company and he's looking at turning it around. And what Bill Ackman is, he's an activist investor, which means that he invests in companies and shakes up management to optimize shareholder returns. So again, in the case of Canadian Pacific Railway, he was seeing that it was run poorly in comparison to other railways, and he brought in a new CEO, Hunter Harrison, who improved the operating efficiency and the margins of that railway business across the board. And then I believe Ackman, his return after that was about, it was in excess of 200%. Now, but what one can do if they're confident with the activist investor is that one can ride the coattails, or for example, invest in the same companies that Bill Ackman invests in, in the hopes that Bill optimizes shareholder returns. If you go to zerohedge.com, you'll see that Bill Ackman recently invested in 2 new companies, which are currently undisclosed names, but we'll find out soon which 2 new companies he's invested in. Okay, so next up is Bill Carrigan. Bill Carrigan is a technical investor. So he's not bottom up, he's not top down. He doesn't look at income statements, balance sheets, or cash flow statements. What Bill is that he is a chart reader, I guess you could say. He'll look at a stock chart, he'll pull it up, he'll look at trend lines and other technical indicators to determine whether it's a stock that he wants to invest in. He posed a question to me in my book Market Masters. He said, Robin, when I was young, I had 2 choices: a stock that was doing nothing or a stock that was going up. What do you think I invested in? And obviously he said the stock that was going up. So he follows with smart money as well, through volume activity. And what he explained to me in Market Masters is that if you go to stockcharts.com and you pull up any stock chart, let's say we'll pull up Spin Master Toys, he'll then overlay 2 things on that stock chart. He'll overlay an indicator called accumulation distribution, as well as on balance volume. When he overlays accumulation distribution and on balance volume, he can actually clearly see the volume activity of that stock. And he has actually in the past been able to identify takeovers before they've happened if he sees unusual volume activity in those stocks, especially for small cap and mid cap stocks in the market. So again, if you go to stockcharts.com, you can overlay those technical indicators to read further into a stock. Okay, so some of the resources that I like to use to analyze stocks: Morningstar. You can get 10-year key metrics on any company. Google Finance, I like to check out for any stock quotes I want to see, like for example Bell, as well as the stock screener. Stockcharts.com for the technical indicators, as well as the news outlets like Financial Post, Bloomberg, and of course Report on Business, especially the Saturday edition. So just to, this is a shameless plug again for my book. I had many endorsers for the book. The guy who wrote the Essays of Warren Buffett with Warren Buffett, he said first class interviews of successful investors. If you go right down to the bottom, Ken Fisher, who is the son of Philip Fisher. Ken's a billionaire in the United States. He said, great addition to the Canadian investing literature. And there's more endorsements as well for my book. Once again, you can pick up Market Masters at Indigo, Chapters, Kohl's, or online at amazon.ca. I would love for you to sign up for my newsletter. If you go to robinspeziale.com, you can click on newsletter sign up there, or email me at r.speziale@gmail.com if you want to talk stocks. So I just want to thank you again for joining my segment at the Canadian Investors Conference. It was a great opportunity for me, and I hope you learned a lot here. But again, buy my book Market Masters, and there's a lot more to learn. There's 20 investors in total in my book. tons of investing strategies, and many in which you can start applying today or tomorrow to your portfolio. Thanks again.